Part B, Mercury Pty Limited. Mercury Pty Limited is a resident company with a June year end. So basically this means it runs, a tax year runs from the 1st of July until the 30th of June. Mercury is a registered VAT vendor. Mercury's financial performance has been deteriorating steadily over the last few years. During the 2021 year of assessment, the Board of Directors started to dispose of the company's assets with the aim of liquidating the company in the near future. The assets and liabilities sections of Mercury's statement of financial position as of the 30th of June 2021, so that's at that year end, are shown below. So we give you here the assets and the liabilities. We don't give you equity, can you see? But now, obviously, like any self-respecting accounting student, you need to know that equity equals assets less liabilities. All right. So, we immediately have this difference. So that'll be our equity. They give us information. So let's just, before I go, let's just quickly look. There was cash and cash equivalents, trade and other receivables, trading stock. Over here we've got the tax liability for VAT and income tax, so and the trade and other payables. When Mercury was incorporated, it issued 100,000 shares at R1 per share to its shareholders, so that's contributed tax capital. The company's shareholders have remained unchanged since incorporation. Now already you should start seeing, hopefully, that if our contributed tax capital is 100,000 times R1, then it would mean that if we deduct that from this equity figure over here, that this will give us 685,000. Now, I don't know of what equity comprises of exactly, but this is potentially something like retained earnings, because this is something like share capital, stated capital, however you want to call it now. But I want you to just see, so that's potentially retained earnings. This is not subject to div tax, obviously, and this is what would be subject to dividends tax. Now, the only reason I'm starting to think in this line of things is because they started speaking here about the fact that they want to liquidate the company. So that information might be relevant to us. They then give us the shareholders. There's Nutter, Farsight, and Biggles Trust. Nutter is a South African resident, Farsight is a non-resident company, and Biggles Trust is a resident trust, which we'll see a little bit further below. Then they talk here about VAT deregistration. The company officially deregistered as a VAT vendor on the 1st of August 2021. Now, the moment you see that, you should remember from the VAT Act, Section 8.2, there was a deemed supply if ceasing to be a vendor. In fact, the value rule for that tells us also that we need to calculate the output tax on the lower of the cost, including VAT and the open market value. And that is what they give us over here, as you can see. And they give us this at the 31st of July, which is correct because Section 8.2 tells us that you need to calculate this output tax on the day immediately before you cease to be a vendor. So the cash and cash equivalents, trade and other receivables, trading stock, and trade and other payables. Over here you can see the only one really for market value, open market value, is the trading stock. Cash and cash equivalent, open market value is probably, would mean it will also be 585. Trade and other receivables, probably also 227. Right, and trade other payables 52,000. But those aren't really traded. This is a private company also. Then it says the note on trade and other receivables. At the time of deregistration, the company had evidence that a significant trade debtor had been declared bankrupt and that 15% of the total trade receivables was irrecoverable. Right. So it basically means there's 15% bad debts that we can claim there. Simple as that. Then there's the liquidation process. The company appointed a liquidator on the 1st of August. So that's when they also stopped to be a vendor. So what I want you to understand here is that thus everything here is after being a VAT vendor. So that means you don't have to calculate output tax and input tax anymore. So the first thing that happened, trading stock was distributed. They say the shareholders all agreed that the trading stock could be sold to Nata Limited at cost. So this trading stock over here, 145,000 rands, including VAT 166,750, could be sold for its open market value, but they're selling it at cost. All right. Then there's debts that have been collected. The liquidator managed to collect 85% of the outstanding trade receivables. The balance of trade receivables was considered bad debts and written off accordingly, referred to the comment under the VAT deregistrated heading. So remember, when we looked at these trade receivables, we saw there's 50% bad debts, 85% is that's what's left. 100 minus 50 is 85%. So they're just telling you they collected that. Then there's liquidation costs. The total cost of liquidation was 250,000 rands. I'm just going to remind you, remember, no Section 11A deduction. Why not? Because it's not in the production of income, it's in the process of liquidation. Liability settled, they say as part of the standard liquidation process, the liquidator settled all outstanding debts owed by the company, including the liquidation costs referred to above. So that would mean it's all of these liabilities over here, as well as any others that were incurred. But now you need to remember, these liabilities over here, we already know when we look at this equity, 785, it's already taken into account there. Okay, I'm not saying anything profound there. If it seems like I'm saying something strange there, you'll see when we also start working through it. I'm just trying to remind you that it's already included in the this is basically going to be an opening balance for us. It's already included in there. Because when we do a liquidation, we have to calculate the closing balance of retained earnings. That's actually what we calculate. So we say opening balance plus profit. So I'm plus going to say accounting profit before tax less tax, and that gives us, well, let's say less tax plus other, well, less tax. Let's just say less tax, because that is actually what it is, and that gives us the closing balance. Because everything, remember guys, everything gets filtered through the profit and loss, basically, as it gets paid off. Then they say here, sorry, right before I go down, distribution of holders to holders of shares. The liquidator's final act was to distribute the remaining cash to the holders of shares. Okay. Then we've got the Biggles Trust. Now the Biggles Trust, just as a quick reminder, sits over there also as a 40% shareholder. The Biggles Trust was formed in 2006 in terms of the last will and testament of Nathan Biggles. In terms of Nathan's will, a trust had to be created for the benefit of his grandchildren, and an amount of R1 million had to be deposited into the trust's bank account. The trust would be required to purchase shares, both for the purposes of speculation, so that's short-term trading, so that's trading stock. I'm going to just remind you, whenever you see shares as trading stock, look out for Section 9 capital C. That's just a good thing to have to get into. And it will also be held as long-term investments, so that is capital in nature. SARS accepts the trust classifications between shares held for trading and shares held for investment purposes. Okay, so that's just to tell you that there's no argument, nothing strange there. In terms of the trust deed, none of the beneficiaries have a vested right to any income or capital of the trust. Trustees must use their discretion in distributing income and or capital to the beneficiaries. So this just means there's no one with a vested right. Information pertaining to selected transactions are provided below. Okay, now, before I continue, this just means when you look at income retained in the trust, for example, if there's donations, then the donor should be taxed under Section 7.5. If there's no donation, if nothing I've seen here so far as a donation, then it will mean things like the trust should be taxed on the amounts which are retained. It doesn't belong to someone else. It's just all those normal rules. So here's some transactions. So transaction number 1. The trust sold 5,000 shares in Helper Limited for 250,000 rands. These shares had been purchased during the previous year of assessment for 320,000 rands. The market value of these shares decreased significantly after allegations of a fraud scandal involving senior management was exposed by the media. The Helper Limited shares form part of the trust's trading portfolio. So this is trading stock. So that over there is opening stock. That over there is gross income. But now remember, if it is trading stock, we have to consider Section 9C. Right? Now what I want you to see is Section 9C is if held 3 years or more, then capital when sold. Now what I want you to see here is how long did we have these shares? We don't know. Now if you see that, if they told you it's trading stock and you don't know how long you've had it, you can't assume that you've held it for 3 years or more. So you won't apply Section 9C to that. Okay, be on the lookout for that. Then they say they distributed to Sally Biggles, who's 15 years old. Sally is the granddaughter of the late Nathan Biggles. All right. Now, she's a minor. Can we apply Section 7.3 here? When does that apply? There must be a donation and must be parent plus child. Not grandparent, not aunt, not uncle, not sibling, parent. Doesn't just say adult or anything like that. Now in this case, there's not a donation and there's not a parent-child relationship, so Section 7.3 will not apply. So who should be taxed on that? Sally should be taxed. And that will be under Section 25B1 plus 2. Basically 2 says that 1 should apply this if it's paid into her, even though she doesn't have a vested right. Then number 2. On the 15th of December of the current year of assessment, the Biggles Trust received a distribution from Galumpi. The shares had been purchased 39 months ago for a total of 400,000. Now be careful there, because the Section 9C rule of 3 years. But then they tell us it forms part of the trust's investment portfolio. So this is capital, and I'm just reminding you, so thus Section 9C would not be considered. And the reason why it wouldn't be considered, the Section 9C makes it capital, but this is already capital. The Biggles Trust received an amount of 80,000 rands in its bank account. Watch out for that. If that's an amount, that means thus, after any potential tax. The directors of Galumpi indicated that 30,000 rands of the distribution to the trust had been designated as contributed tax capital. Okay, so that means they received a distribution of 80,000. 30,000 of that is contributed tax capital, so that means 50,000 rands is a dividend. But important here, you have to remember it's in its bank account, and this is, so that's 50,000 there, is after dividends tax. No amount of the distribution received from Galumpi was transferred to the beneficiaries of the Biggles Trust. So thus, the trust should be taxed. Now guys, I know it looks like I've written down a lot of things. I mean, these things are quick for you to do. Obviously in an exam you won't necessarily write down everything, but most of these comments I made here, those are all things that I would basically write down and consider just to remind myself. Because your mind must be active as you go through it. Don't try and answer the question, but think of the things which are going to impact you. Okay, so that's it for the reading time. In our next video, we will start with the required.